Malaysia's economy, as measured by gross domestic product, grew 3.3% year-on-year in the third quarter, driven mainly by private sector expenditure. Growth was slightly better than the 2.9% seen in the second quarter, but lower than the 5.6% year-on-year growth in the first quarter. On a month-to-month basis, GDP growth moderated from 4.2% in July to 3.2% in August and 2.5% in September. Quarter-on-quarter, GDP was higher by 2.6% in the third quarter, faster than the 1.5% quarter-on-quarter growth recorded in the second quarter, according to a statement from the Department of Statistics Malaysia. Overall, the Malaysian economy expanded by 3.9% year-on-year in the 9 months of 2023, compared with 9.2% last year, the DOSM said. Bank Negara Governor Datuk Sheikh Abdul Rashid Ghaffur said Malaysia remains on track to achieve its GDP growth target this year, albeit at the lower end of its forecast range of 4 to 5% for this year. Speaking at the GDP briefing, Abdul Rashid said that by now there are many indicators showing how resilient the economy is, adding that despite the external shocks, growth in the first 3 quarters of the year was 3.9%. He adds that looking at indicators in terms of GDP growth for this year, the central bank sees positive growth in terms of demand for passenger cars and private consumption. Meanwhile, the central bank kept the Malaysian government's projection that the country's economy would grow between 4 and 5% in 2024. Abdul Rashid said that on the global front, slower than expected recovery in external demand is a key downside risk factor, while on the domestic front, weaker labour market conditions, more severe shocks on commodity production, and prolonged plant maintenance could also potentially weigh on growth outlook. In terms of upside risk, this could mainly stem from stronger than expected tourism activity, faster recovery from tech cycle downturn, as well as a larger impact from the progress of multi-year investment projects and recently announced policy measures. He also added that BNM's GDP projection for 2024 has also taken into consideration the impending increase in the sales and services tax. On the impact of the US monetary tightening policy on ringgit movement, Abdul Rashid expects that the US monetary policy is maybe at the tail end of the tightening cycle, and that once that happens, the ringgit could strengthen. The Employees Provident Fund registered a total investment income of 47.86 billion for the 9 months of 2023, representing a 33% increase from the 36.04 billion recorded last year. Total investment income for the third quarter was 14.67 billion after netting off write-downs, up 19% or 2.38 billion from 12.29 billion recorded in the corresponding period in 2022. For the third quarter, equity investments remained the significant contributor to the pension fund, accounting for 63% of the total investment income in the quarter, with 9.17 billion generated after netting off write-downs, according to the EPF. Meanwhile, fixed income instruments comprising Malaysian government securities and equivalents, as well as loans and bonds, remained the anchor amid short-term market volatility, contributing 32% or 4.76 billion to total investment income. CEO Dato' Amir Hamzah Azizan said that during the third quarter, the pension fund witnessed global equities posting a negative return, shifting significantly from strong gains experienced in the first half of 2023. He adds that the Gaza-Israel war and the ongoing Russia-Ukraine conflict will undoubtedly contribute to an atmosphere of uncertainty. All of this, plus numerous other challenges, he says, has introduced a new dimension to the global economic landscape, one that requires the EPF to implement a vigilant and adaptive approach. The EPF also lauded the government's efforts on the recently launched Malaysia New Industrial Master Plan 2030, which provides a strategic direction to develop the nation's industrial sector to become globally competitive with high economic complexity. Meanwhile, the EPF said it continues to record growth of new member registrations at 365,519, adding to the total number of EPF members as at September 30th, 2023 of 15.99 million. In order to achieve its coverage target of more than 60% active members of the labour force by 2030, the EPF intensified its outreach programs and proactive stakeholder engagement. The EPF also recognized the growing trend of informality in the Malaysian workforce and the challenges it poses for the lack of old-age social protection coverage. As such, the pension fund remains determined to expand its coverage to this segment through the mobilization of 41 vehicles and 10 mobile trucks as part of its outreach to those in the informal sector and self-employed workers across the nation. Affin Bank posted a net profit of 100.45 million for the third quarter from 872.4 million a year earlier. The big earnings contraction was mainly due to a one-off gain of 1.06 billion from the divestment of its asset management business a year ago. It is worth noting that the hefty divestment gain lifted the banking group from a net loss from continuing operations amounting to 193.5 million to a net profit of 872.4 million ringgit. The group's net loss was weighed down by allowances for credit impairment losses of 233.5 million previously. However, the bank pointed out that its earnings were impacted by net interest margin compression due to elevated cost of funds. Net income dropped by 6.3% to 500.4 million as the impact of higher interest expenses was cushioned by net gain on financial instruments plus other income. As of end September, gross impaired loan ratio had recorded an improvement to 1.84% compared with 1.91% a year ago. President and Group CEO Datuk Wan Razli Abdullah said 2023 had been challenging amid margin compression due to elevated cost of funds led by the US Federal Reserve. He notes that the group had made progress in its current account savings account strategy, which had grown 21.4% year-on-year to 16.6 billion, and the strategy will be powered by the launch of the new Affin Always mobile app. These developments are aimed at countering global challenges by bolstering CASA and staying on track with the group's long-term A25 transformation plan. Wan Razli notes that the group had successfully issued the second additional Tier 1 capital and the first Tier 2 issuance of Affin Islamic Bank for the year in October. CelcomDigi saw its third quarter net profit jump 72% year-on-year from 264.5 million to 455.7 million ringgit. However, after adjustments to reflect the CelcomDigi merger, PAT before adjusting for minority interest slipped 3.77% from the third quarter of FY 2022 as the telco had revised the useful life of its assets and rationalized its sites. As a result, it depreciated some assets faster than a year ago, which ate into its earnings since the fourth quarter of FY 2022. On a quarter-on-quarter basis, earnings improved 33%, helped by lower regulatory and network-related costs and lower marketing spend. The improved quarter-on-quarter performance was despite a marginal 0.61% increase in revenue to 3.1 billion from 3.12 billion on softer device sales and lower postpaid revenue, while prepaid and home and fibre revenues improved due to increased subscribers and data adoption. The group added 123,000 subscribers in the quarter, expanding its base to 20.6 million. It declared a third interim dividend of 3.3 cent per share, bringing total dividends for FY 2023 to 9.7 cent per share. Commenting on these results, CEO Datuk Idham Nawawi said that the group is happy with the progress made on the overall business integration, especially in delivering the country's widest and fastest network, while its focus on market execution and prudent cost management contributed to its solid performance. He also points out that CelcomDigi had launched its new brand in October, which Idham says enables the telco to serve its customers more seamlessly and introduce new offerings into the market. Media Chinese International expects to record losses attributable to owners of the company of between $4.5 million to $5.5 million for the 6 months ending September 30th, 2023, compared with the profit attributable of $1 million reported a year earlier. In a BORS filing, MCIL said this increase is primarily attributed to the absence of one-off government grants and subsidies of approximately $1.9 million recognized last year. Additionally, there is a decrease in turnover from the publishing and printing segment for the 6-month period compared with the corresponding period in the previous year. MCIL issued this profit warning to its shareholders and potential investors based on a preliminary assessment of its unaudited consolidated management accounts and the information currently available to the board.